So far, we've talked about self-insuring the risk for long-term care in addition to traditional long-term care. And we talked about the pros and cons of both. So if there are more cons than pros for both of those options, let's now talk about asset-based long-term care. So hint, hint, this one's going to include annuities. So if you're a fan of annuities, be sure to check out this video. Hi, my name is Darlene Hartman. I'm a CPA and financial planner with Money Concepts. For weekly retirement planning and annuity advice, be sure to subscribe to my YouTube channel and hit the notification bell so that you can receive notices anytime I post a new video. So let's get started on asset-based long-term care. Well, I have been promising you that we would talk about long-term care. So today is the day. And I have invited a guest speaker, Jay Robinson, who's an independent insurance consultant with Insource, to help me provide you information on long-term care. So I talk to Jay anytime I have a client with specific long-term care needs, because he has that direct relationship with the insurance carriers and know the pre-qualifications that are needed for each long-term care product. So on that note, I'm going to introduce Jay Robinson of Insource and let him take the presentation from here. Good morning, Jay.
Good morning. Thank you. What we're going to talk about is asset-based LTC. This has been in the insurance industry the largest growth, the most requested over the last 7 to 8 to 10 years. And we're going to see why in a second. Asset-based long-term care. It is a life insurance or an annuity policy that takes a set amount of money and turns it into a long-term care benefit. It focuses on long-term care benefit. So while it's a life insurance policy or an annuity policy, and that's great, its emphasis is on long-term care. And typically it will provide 2 to 7 years of long-term care benefits. There is an option out there, one carrier right now with inside the asset-based LTC, that you can actually purchase a policy and have an unlimited lifetime benefit, unlimited. So as we go back to the stats a few slides ago, those 7 men and women that had the long 10, 12, 14, 19-year claims, a policy with a lifetime benefit pool would pay that income stream the full duration, whether it's 19 years or not. 2 of the 6 activities of daily living are still required. It is still LTC. And we commonly see these policies funded with single premiums. It can be an annual premium, but it might be using some savings and repositioning it to move it over and leverage up into that 2 or 7 or unlimited benefit duration. But it can be set up on a 10 pay, a 20 pay, or a lifetime pay as well. Pros and cons. Everything about asset-based long-term care is fully guaranteed. So there are no premium increases. If you purchase a policy with a 20 pay, 12 years from now, the premiums will not increase. You purchase a policy with a single pay, 20 years from now, the policy will not be forced to run out. Everything is fully guaranteed to the claims paying ability of the carriers that provide it. These policies, while it's life insurance or annuity focused, they do offer life insurance or annuity benefit, but the focus is long-term care. So compared to a traditional LTC that has just one feature, these policies might offer a decent life insurance death benefit. So if we put money into it and we never need care, our family or someone as a beneficiary will still receive an income tax-free death benefit, for example. The policy has guaranteed cash surrender values. So we might move over, again, a single premium. We might make one-time payment, but we know in the future, because the policy is guaranteed, if we change our mind, if we want access to the money, it does have guaranteed surrender values that we could surrender the policy or take distributions from if needed as a worst case scenario. Typically, you can add inflation. Most of the carriers and the products out there do have a 3% simpler compound or 5%. Inflation is an option with these asset-based LTC policies. Everything's guaranteed. As you look at an illustration, Everything is simpler to understand than some of the more complex versions of traditional LTC or life insurance with a long-term care rider. Like traditional LTC, this does cover home health care. So I want to emphasize the point. It is not nursing home care. This is extended care. This is long-term care. And these policies do cover the cost, the expenses of someone coming into your home to take care of you. And like traditional LTC, your family would have access to a care coordinator to help along the way determine the right path of care that's needed. Two big cons with asset-based LTC. And one, claims process. Again, you just have to work with an insurance carrier. The insurance carrier would work directly with the care provider, but you do have to qualify with underwriting. You do have to provide a history of your medical information. Some carriers might do this on a phone call only. Some carriers might get more detailed and need lab work done, for example. So it is a little bit longer process than if we self-insured and didn't do anything.
All right, so I have another question for you. Go figure. So I have done so many videos on fixed annuities that I want to ask this question, because what I understood about a fixed indexed annuity with a long-term care rider is that you should consider that as supplemental coverage. And then I also want to ask, I'm going to throw this in because I think you can answer both at the same time. I also heard that there's a lot of fixed indexed annuities with a long-term care rider where underwriting is not required. So can you clear those two things up for me?
Correct. So with annuity products, whether it's an indexed policy or a fixed policy, and we won't get into that today, you can purchase and use annuity dollars, one of these annuity policies with long-term care. And the neat thing about this is you might get 3 times or 5 times your deposit as a total benefit balance. So even better, even though it's an annuity policy, because of the Pension Protection Act, anything taken out for long-term care is received income tax-free. Wow. So anything, even with gains, can be received income tax-free to help cover the long-term care costs. Now, as it relates to the second question, you are absolutely correct, because many of these policies, depending on how you design it, there could be just knockout questions. It could just be answering 10 or 12 questions and being able to get a policy. Some policies, some annuities, if you do turn 100,000 into 500,000, for example, you might have to provide a little bit more insurability, more medical underwriting just because of that leverage. But you can get some of these policies by answering correctly to a dozen different health questions and being done. It's a pretty quick process with that.
That makes total sense. Thanks for clarifying that.
Absolutely. And with that, Darlene, I'll turn it over to you.
Well, thank you so much, Jay, for taking this time. The presentation was very enlightening and informative, and I appreciate you spending this time with me. And if you're interested in obtaining long-term care, no matter which option that we discussed today, be sure to click the link below to apply to become my client. And also, don't forget, if you like this video, give me a thumbs up, subscribe to my channel, and share it with your family and friends. Let's get the conversation started on how you can live your best retirement while not outliving your money.